let's now talk about using the major trend system to trade ETF options. And in general, trading options allows you to start small. And I've been investing in options for more than 28 years. And when I first started out trading options, I only had a $4,600 trading account. But within my first 2 years of investing, I realized more than $460,000 in profits, starting with that $4,600 trading account. And here's some snapshots of those first 2 years of option trading, where I made over $460,000 those first 2 years. These are copies of my tax returns. So the reason you can start small with options is because of the leverage that options provide. And I'll show you some examples of option trades that I took so you can understand this concept of leverage. Now, if you want to profit using options, options are derivatives that derive their value from the price of the underlying ETF. And the intrinsic value of a call option will increase 1 point for each point the underlying ETF increases above the strike price. And the intrinsic value of a put option increases 1 point for each point the underlying ETF decreases below the strike price. So if you want to profit using options, you have to identify the trend and then determine whether you're going to take a bullish or bearish position. And by using the major trend system, we can identify markets that are bullish and buy call options, and we can also identify markets that are bearish and we want to buy put options. So the way to profit in options is to look at the price movement of the underlying ETF. That's what determines your profit or loss in an option position. So that's the most important criteria when you're trading options. So we want to use the major trend system to find ETFs moving up in price so that we can purchase call options. And then we can also use the major trend system to find ETFs that are moving down in price, and then we want to purchase put options. And again, your profits when you're trading options are going to be determined by the price movement of the underlying ETF. So that's the most important criteria that you want to look at. Okay, let's take a look at some actual option trades that I took using the major trend system. And these markets were on a buy signal when I purchased these options and option spreads. And here's an example of the Brazil fund, and I purchased call options and option spreads on this ETF based on the major trend buy signal. And we can see the 1 month price of the ETF is above the 20-month EMA, so the Brazil ETF was on a buy signal, and I purchased bullish call options and option spreads. Here's another example. This is the Europe, Australia, and Far East Fund. This was on a buy signal. The Builders Emerging Markets ETF was on a buy signal. And the last one is the Global Energy. So I'm going to show you my brokerage account statements that show positions in these four markets. And this portfolio had a $50,000 profit and an average return of 70%. So again, I purchased these options and option spreads based on the major trend buy signal that I had at the time. So these are just examples of option trades I took using the major trend system. Now let's look at the leverage that options provide, and I'll show you some actual examples, and we'll compare the return of the option to the return of the ETF, and you can see that these options are leveraged about 6 to 1 to the ETF. And this first one I'm going to show was the emerging market ETF. It was on a buy signal according to the major trend system. So I bought 5 of the June 100 strike call options at 14.20. Then I later sold these 5 options at 29.30, and I had a $7,500 profit, net profit after commissions, and a 106% return. And over the same period of time, the emerging market ETF was up 16%, and the option was up 106%. So the leverage the option provided was about 6.6 times the leverage that you would get from owning the ETF. So this is just an example of the leverage that options provide. Of course, that can work both ways. If the ETF goes down, then you're going to have a much larger loss than owning the ETF. So it works both ways, but if you can time it right, you can get a good return using options because they're leveraged. And here's a profit graph. This compares the ETF return. This was about a 6-month period, and we can see that was about a 16% return versus 106% return for the option over the same period of time. So this just shows you the leverage that options provide. And if you were to compare the investment and the dollar risk, if you bought 100 shares of the ETF, it would have cost at that time $11,130, and over that period of time you would have had a 16% return. And as opposed to the option, instead of costing $11,000, the option was $1,420, and that had a 106% return over the same period of time. So this just demonstrates the leverage that options provide. And here's another example. I bought 10 of the Brazil ETF 45 strike options at 8.20, and bought 10 of the Builders Emerging Market 34 strike options at 5.20. Sold the Brazil options at 14.90. That resulted in a $6,600 profit, 82% return. And the Builders Emerging Market, that had a 104% return. And over the same period of time, the Brazil ETF produced a 14% return versus 82% for the option. And the Builders ETF had a 16% return versus 103% for the option. So again, these options allow you to get a higher rate of return compared to the ETF over the same period of time. And on average, those 3 trades that I took had about 6.2 to 1 leverage compared to the underlying ETF. So let's now take a look at profiting in down markets, and here's the major trend chart for the emerging market index, and we can see the 1-month price above the 20-month EMA right here, but then in April or May, I guess this is around June, of June of 2008, the 1-month price crossed below the 20-month EMA. So now the emerging market ETF is on a sell signal. So once that occurs, you want to think about exiting your long positions and start taking short positions. Again, this is the major trend. This is the long-term trend of that ETF. And when that 1-month price drops below the 20-month EMA, that's usually a sign that that market is now bearish. And you should definitely not be taking bullish trades when the major trend turns bearish. So I found over time that shorting a stock or an ETF incurs too much risk. So what I did to take advantage of this sell signal was I simply bought the short emerging market index. This is an inverse ETF, symbol EEV, and this moves inverse to the emerging market ETF. And my brokerage statements here show that EEV, which is the short emerging market index ETF, I bought 600 shares, and at the time I had a $9,155 profit. So this short ETF, EEV, that profits if the emerging markets ETF is going down in price. So the major trend had turned bearish at that point, so I was in all bearish positions in various global markets at that time. And here's a snapshot of one of my portfolios. This was on September 15th, 2008. And on that day, the Dow dropped 504 points. And I closed out trades that day totaling over $14,900 in profits after commissions. And I had an open trade profit of $18,262. So I had a 14.5% return on the day that the Dow dropped 504 points. So that shows you the advantage of taking these short positions during down markets. So,
Chuck, do you ever correlate ETFs with your long positions as a hedge, or do you keep them completely separate?
The question is, do I use the short ETFs in conjunction with the long ETFs as a hedge? And I usually just follow the major trend system, Tom, and if the market is on a sell signal, then I'll take a bearish position. If it's on a buy signal, I'll take a bullish position, but I don't really correlate the bearish and the bullish positions. And right now, we don't have that many bearish positions on, and but that that can certainly change. And the last two bear markets, we were heavily short, and we had great profits in the bear markets with these short positions.